Hello, everyone, and welcome to our session titled The Transformation of Value Exchanged. I'm so excited to be joined by our experts today to talk about everything from Bermuda's definition of a digital asset to what's happening with payments around the world. Are we moving to a world in which the next generation of investors may never even touch a physical bill or a metal coin? So to join me in this conversation today, I'm joined by Moad Fahmi, the Senior Advisor of FinTech at the Bermuda Monetary Authority, Dante Disparte, Chief Strategy Officer and Head of Global Policy at Circle, Eric Kryski, the co-founder of Bidali, and last but not least, Joseph Seibert, Group Managing Director and a Senior VP of Digital Asset Banking at Signature Bank. And my name is Sheila Warren. I'm the Deputy Head of the Center for the Fourth Industrial Revolution Global Network at the World Economic Forum. So Moad, let's start with you. Tell us, how did Bermuda settle on its definition of digital assets? And why is this something that the BMA even decided was worthy of paying attention to in the first place?
Thank you, Sheila. I'm happy to be here live and looking forward to being live in the flesh next year to this event. I think there are a few components to that question. I think the first component is, why did the BMA decide to pay attention to digital assets? I think, the BMA has broad experience in developing risk-based regulatory framework that support innovation. It's done so in the past, especially in the insurance sector, where Bermuda is one of the world's leading jurisdictions, as most of you know. Therefore, in 2018, when it was time to develop the framework for digital assets, the BMA was in known territory and was able to leverage collaboration with industry stakeholders, government to bring the framework to life, right? When we're talking about the Bermuda ecosystem, it was something that the BMA developed in collaboration. Then I think the second component to this question is about the definition. And I think that's where a lot of jurisdictions struggle. They spend a lot of time thinking about the taxonomy and which regulator should be responsible for what. The BMA has got the benefit of being an integrated regulator, meaning that it supervises all financial institutions in Bermuda. So it's got a broad remit. So when we designed the definition of digital assets under the Digital Asset Business Act 2018, we decided to create that definition in a very broad way to capture almost all digital assets without distinction for the traditional. Is this a utility token or digital asset? Is this a payment token? Is this a security token? And then, kind of deciding which regulatory agency would be responsible for it. So the way we defined it very broadly provides the legal certainty that, look, if you're operating with digital assets, generally you're likely covered. And then we can focus on the actual business activity and risk profile of that activity to ensure that the framework is well designed and avoid the categorization of assets where it seems like a lot of jurisdictions are struggling. So in that sense, I think the definition is very unique. Then I think the last component is, when we consider the definition, what did we want to bring within the scope of the legislation? And when we think about the Digital Asset Business Act, we wanted to cover the end-to-end ecosystem of digital assets. That's because this ecosystem is connected. The various parts working together well will create the customer protection and the customer confidence that is needed to bring the adoption and properly manage risks across that industry. So digital asset businesses are everything from exchanges, custodial wallet service providers, payment service providers, market makers, trust service providers, issuers, derivatives exchange, with the goal of looking at the entire chain of actors and making sure that it works well together. Because if there's only one link to that chain that is weak, then that's likely where the industry will get attacked.
Thank you for that. Dante, I want to head over to you. We've heard about this unique approach now from Moad. What has this unique approach meant in terms of Circle's engagements in Bermuda? And also, why should others outside of Bermuda be paying close attention?
Yeah, well, first of all, Sheila, it's great to share a virtual stage with you and a virtual stage and a virtual presence with Bermuda at a time when this novel industry, this emergence of a veritable internet of value emerged. Bermuda was the sea of regulatory clarity, was the island rather of regulatory clarity in a sea of regulatory uncertainty. And so much of what has been enshrined in Moad's comments and in the Digital Asset Business Act is now being replicated in many jurisdictions around the world. So Bermuda, I think, long home to responsible financial services innovation, long home to innovation and deep linkages. I like the chain analogy that Moad mentioned. You know, you could borrow it into, for example, insurance markets, reinsurance markets, where Bermuda is really one of the most important jurisdictions and regulators in the world. And some of it, I think, ought to be replicated. All too often in the blockchain and crypto assets industry, people describe path of least resistance approaches to regulations where operators are looking for regulatory arbitrage or havens. I think the model of a whole of government approach that doesn't try to effectively pigeonhole the assets and stop innovation, but bring it into the line of day and strategically leverage the kind of concept of co-creating with private industry and practice and investors and operators and the regulators, co-creating a manual for examinations of these industries, examinations of these novel assets, and then how they can be grown and continue to evolve is massively important. Circle, as a company, was one of the first, if not the first, to get a comprehensive license in Bermuda. We're very committed to continuing to innovate from Bermuda and in broadly speaking, hopefully export from Bermuda the types of standards of practice and regulatory oversight that can be teachable to many jurisdictions around the world. So, I think that kind of farsightedness has improved economic competitiveness, I suspect. It's certainly driven our investment thesis for making Bermuda part of Circle's Center of Excellence in core operations. And I think there's a lot to learn from that operating model of whole of government approach to fintech innovation, as opposed to the type of parochialism and territorial turf wars we see in many jurisdictions around the world.
Well, you're certainly speaking my language here at the World Economic Forum. We do emphasize the importance of co-creation and taking a multi-stakeholder approach to things like regulation, particularly in brand new spaces where the innovative path is yet to be hacked through the jungle, if you will, right? We don't really know what direction things are going to go. And so that balance that I think you're talking about and that we heard in Moad's articulation of this need to protect consumers and ensure that there are adequate safeguards in place, but also ensure that we are not stifling innovation that could actually wind up benefiting those very consumers is a really tough one to strike. And so, Eric, over to you. Moving even beyond Bermuda, what changes and global trends are you seeing in payments specifically? And do you think that cryptocurrencies are going to play a bigger role, a different role over time?
Yeah, thanks, Sheila. And thanks to everybody for joining on the panel. I second a lot of what Dante was saying. I think this is why we're pursuing DABA license registration in Bermuda as well. Seeing that the regulatory framework is world class. I would say right up there, probably Singapore and Bermuda being the top two that are providing the most regulatory clarity today. And I think what's important is that in order for digital currencies to gain adoption in a mainstream way, not sort of in the speculative way that we're seeing today, and that's where we've been focused, is real world utility and more open financial access. You need to have that level of trust. You need to have that level of safety to protect consumer deposits and business deposits. And so I think it's really important what Bermuda's doing, and especially with them being so highly regarded with FATF. I think that was one of the reasons we've been looking at it. Now, bring it to your question. I think what we're seeing more broadly is that, obviously at Circle, the growth in USDC has been exceptional, to say the least. I think that's a byproduct of a lot of people using it because of the lower cost basis compared to, and frustration. If anybody's sent a wire internationally, they probably know the pain. And if nothing else, I'd hope that we have more transparency and being able to verify when funds have actually been received by a counterparty. That's really important, and something that's largely goes, I think, under highlighted with our traditional financial infrastructure. I think with Circle's USDC, what we're seeing is a lot of growth now outside of the speculation side. We're seeing early stages, even with our business, of people that are starting to use it to pay for real goods and services because they're getting paid in USDC, or investments are occurring in USDC. And a lot of this is because you can start to settle value in a trusted way 24/7. And I am quite bullish, I think. Obviously, I wouldn't be in the space if I wasn't, but I think, I'm very optimistic about how digital assets, specifically stable digital assets, transform financial access overall. And I think, that's part of our goal in Bermuda, is to be able to pilot some of those things under a safe regulatory environment. But I think where we're going to see the uptick is where we're already starting to see a little bit of it is in specific industry verticals outside of the speculative aspect, as well as in markets that are financially underserved. So specifically Latin America, Southeast Asia, and Africa. So I'm very excited to see where things go. I think we're only just getting started, really.
Definitely. And I think, the point Dante was making there, and you as well, like there's this diversity of approach for sure. So Joe, the BMA does have the benefit of being an integrated regulator, as Moad noted. But if there is a spectrum of integration, maybe the US may be on the opposite extreme of that, I think maybe is safe to say, in terms of not being an integrated regulator. So how is regulatory activity in the United States? There's obviously quite a bit of action happening up here at this time, both at the federal and state level, of course. How is this shaping the digital asset ecosystem globally, both domestically and globally? And what do you think are the implications on the global economy?
There we go. So thank you for having me, Sheila. Nice to join Dante, Eric, and Moad. Pleasure being here. And I can't wait to get back to Bermuda. FinTech Week a couple of years ago seems like forever. But yeah, to say that the U.S. is behind is probably an understatement. I think we're all aware adoption is occurring rapidly, more so now than ever. But if you look at some of the announcements just this past week, and as Dante can attest to, they're really focused on stable coins right now, and I don't think they know what to do with them here yet, so to say. New administration, new plan, but walking it back a little. Coinbase made an interesting announcement and filed a report that they would like a separate regulator here in the U.S. to handle digital currencies. They feel it is such a different animal, and it is. And the effects of the global economy is we have to catch up here in the States to the adoption that has occurred overseas in Asia and Europe for the past 6 or 7 years. And the only way to do that is to really have an open forum and sharing of ideas. And being, with Signature Bank, we're headquartered in New York. We deal with the New York Department of Financial Services and the FDIC. There's also the governing body of the OCC, the SEC, the CFTC. They're all trying to figure out how to work, through this. So there are some tokens that they may deem a security. There are some that are not. Then they want stablecoin administrators to be regulated like a bank. So there's a lot involved in conversations ongoing right now. But what we see from the bank level is at least it's a conversation that's moving forward. Where I think 3 years ago, there was so much uncertainty. We weren't sure, if it was going to be fully adopted or even acknowledged in the banking system. And even from the payment side, we built Signet to really eliminate friction, because we understand a lot of our clients are overseas. We bank, we're global friendly. So we bank, not only do we have the agreement with Bermuda to provide banking services for your clients, we're trying to really open this up to jurisdictions that we're comfortable with, their neighboring jurisdictions, and help the global economy. The U.S. is always going to be looked at as the forefront for economic standards. But, when you have crypto involved and the U.S. dollar conversations behind it and stable coins behind that, it gets really interesting, I think, as you look at the next 3 to 4 years. I think 2022 will tell a lot once the mandates come down for stable coins. And then I think banks will take shape after that here in the U.S. But I do think it's positive. I think that we need regulation to stamp the footprint here. And then it'll really open up economic development around the world from there, especially on the banking side.
It's really interesting. I'll take a quick moment to just remind our listeners, we are live. So if you have questions for the panel, please do put them into the comments in the chat and we can pull them up and make sure that you get to hear from these experts. But I want to follow up a little bit on what we've just been talking about right now. So we do have the U.S., I think widely, I think it's pretty axiomatic to say, recognized as the global reserve currency. That's true. Even in the crypto space, I think we all acknowledge that reality. That's probably a reason that the U.S. has been late to the game in looking at some of these things. There's a responsibility there, I think, that is quite profound. But the other actor that is a major player in the global economy is, of course, China. We know that digital yuan, DCEP, is in production. It's out there. It's real. And there has been this notion that the U.S. and China are developing, or assuming the U.S. proceeds with what some of us are hearing might be plans, there are going to be very different approaches to this. And so a couple of questions for the panel, and anyone can really just jump in here. How do we think about this global frame, right? And how can jurisdictions that are small but mighty, like Bermuda, compete in a sense with some of these larger countries that have gigantic economies, gigantic populations, lots of overseas investment, corridors that already exist, China into Africa. We could talk about the US into half of Latin America. We could talk about how can we make sense of that? And certainly because Bermuda does have this unique and highly innovative approach to regulation, benefiting again from being able to work cleanly across a variety of different sectors because of the integration. What do we make of that? So maybe Dante, I'll turn to you first, just to kind of help us make sense of that global landscape and the frame I just laid out there.
Yeah, I mean, for one, and I'm on the record on saying this, so no better place to repeat it than the home of responsible financial innovation in my virtual presence in Bermuda. I think the concept of central banks fundamentally disrupting the private sector and the two-tiered banking system and payment systems innovations by having to pick a point-in-time technological standard to issue a digital currency is a patently bad idea. It would negate the fact that the vast amount of money in circulation today, what I classify as value-added money, whether it's enshrined on a plastic card or rides on rails or rides on blockchains like USDC, the world's fastest growing dollar digital currency, it's all the sum of the parts. It's all the sum of free market activity, addressing challenges and frictions that candidly, until only very recently, the question of financial exclusion and insidious rates of fees and the lack of interoperability in our payment systems, it was not until my prior project, candidly, that moved from being an object of admiration in the global policy discussion to a question of actual free market competition. Companies like Circle are actually powering an era of low friction, high trust payments around the world. And it's no longer an abstraction. USDC has supported more than $1 trillion of on-chain transactions. Companies like Visa are enabling it across a merchant pool of 70 million strong all over the world. Companies like MoneyGram using the Stellar blockchain have created real world fiat on and off ramps for that super insidious but massively important cross-border payment of remittances. And a lot of this has the domicile of the United States enshrined under bank state supervision regulation. So when people say stable coins are not regulated or they're poorly regulated, I would say not all stable coins are created equal. But I also challenge that because the lab for fintech innovation in this country, at least in the US, is the state-based money transmission regulations. And it's jurisdictions like Bermuda that are enabling these assets to emerge and get appropriately regulated and find homes.
And I would add to what Dante was saying too. I think, coming back to how does a small country differentiate itself? I think Bermuda is and has been doing that over the last few years, being one of the first groups to roll out a comprehensive Digital Asset Business Act. I mean, I've spoken with Premier Burt a few times about this, that, there is acknowledgement that Bermuda is a small, but, punching above its weight country. I think, and that's actually one of the reasons that one of the factors of many as to why we're working on setting up operations in Bermuda, because with the technology as it is today, the regulatory framework, even the fact that it's physically an island, it makes it a lot easier to be able to test products there, because and reduce the risk to consumers, because there's a lot more control. Even where I'm based in Canada, the Bank of Canada has been looking at central bank digital currencies and doing research for over a decade, but has been hesitant to roll out anything into production because the implications could be quite huge. It's a much larger user base. And I think the other thing that I'm seeing is a lot of central banks right now are looking at, how do we basically make e-cash? How do we digitize all of our money all at once? And I'm with Dante. I think there's different approaches to how you'd roll out, digital money. And our opinion is that a phased, more of a closed loop, and even through stimulus pilots and things like that, are a better way of progressively moving towards that, so that you don't disenfranchise people who may not have the access or the technical capabilities to be able to participate in the newer digital economy that's emerging. And I think a lot of the central banks that we've discussed this stuff with are I think still very focused on, how do we transform all of our digital infrastructure at once, as opposed to taking a phased approach. And I think the unique thing about Bermuda is that even within the Digital Asset Business Act, there is a phased approach that you can go through. So that's how I think they just differentiate, by attracting businesses through a good regulatory regime, as well as having the internet infrastructure and frankly the buy-in of a bunch of key stakeholders within the economy that are interested in encouraging this innovation.
I think for me, if I may, on the transformation front, I think there's kind of two aspects to the transformation, and how the response of the regulator is important. So when we say transformation, it's dynamic, right? So taking a command and control approach, saying, okay, look, this is the state of the world. This is how we're going to regulate it. We know for sure it's going to work. I mean, you're going to either stay on the sidelines or you're going to get it wrong. So taking that approach as a regulator does not work. The way we approach this is twofold. So on the one side, we have the Digital Asset Business Act. Yes, it's a novel piece of legislation, but we've amended it every year since its enactment in 2018, meaning we're at V3. So when we're hearing people saying, well, other jurisdictions are putting it in place, but is it high on their policy agenda so that they can make amendments to make sure that it remains fit for purpose, would be the first component of how do we stay up to date and how do we adapt to this transformation. And then the second bit is really the sandbox approach, right? So when we say we're not in command and control approach, how can we have an iterative approach to regulation and to novel business models? It's via sandbox. And I think the work we've done last year on modifying our sandbox is pretty unique. So we created this 3-tier system where people can come in with a Class T, operate a pilot, focus on what's the nature of the risks of my business project. Is there a business need? Is there a customer advantage or benefit? And then from there, graduate to a transitional license, where they're really going to focus, okay, well, this works. These are the risks. How do I build my risk management and compliance framework? And then move on to becoming a fully regulated financial institution. So, I think these two components, having an agile legislative agenda is very important, but also being able to observe market development and respond to them in real time, because our team at the BMA has, monthly meetings with these companies in the sandbox. It's really a collaborative approach to, responding to the risks that are emerging, but also to understanding how these business models work.
We had a question from the audience that's related. Does the panel think that the rest of the world will catch up with the Bermudan approach to regulating digital assets, or will this approach need to change as the global approach matures?
I can jump in on that, and backing up for a moment too. If you look at China, they're banning mining right now. The U.S. is the second tier for mining. Everyone seemingly is moving to the U.S. and Canada to do those operations. So I don't know if we can answer that question for that region, but I think the world, the globe will catch up eventually, but it might take a long time. If you go back to the USDC example, any stable coin for that matter, regulators have the problem here in the States with trying to understand. They know the on and off ramp, they don't know the in between, the hops. But if you look at cash, it's the same thing. If you take physical cash out of a bank and you exchange that at any store, it'll change hands 1,000 times. We don't know. So getting past that, I think, is the very first step. And I think that's why the US regulation is approaching stablecoin projects first. And then we'll try to figure out, Bitcoin and all the other digital assets thereafter. But it's going to take some time. I don't think this is an overnight process, especially in the States. Again, there's a new administration. There could be a new one within a couple of years. So, understanding those footprints is going to be vastly important. And catching up to the BMA is really up to each jurisdiction. It's how fast do they want to run or do they want to walk? But I think, you're going to be forced into it with the amount of users that are behind this, the amount of growth you see from the stable coins like USDC. You can't avoid it. And people prefer that methodology of transacting.
If I may add to that, I think we keep kind of comparing the Bermuda approach with the rest of the world. And, I think we do spend quite a lot of time with our peers thinking about what's the next step. And, while there's a real need for us to remain agile and, cutting edge, I believe that people are catching up, but I also believe that this catching up is very positive for the industry as a whole. The industry will only grow as the global situation becomes clearer, and not only as a result of some jurisdictions figuring it out. So I totally welcome every jurisdiction that is able to get the regulatory framework right.
Well, one quick intervention on this point, Sheila, that I would make is, having had really just an extraordinary experience of engaging with all of the major regulators around the world on these issues, there is a general consensus on technology neutrality, activity-based regulation. And when it comes to crypto assets, and this is the piece of the puzzle where I think, again, the Bermudian framework is standard setting, is to look at the economic behavior of the asset as opposed to creating a catch-all statement. The term stablecoin is such a red herring because it hardly captures the diversity of all of the types of stablecoins in circulation, or frankly, the real consumer protection challenge we had in the very early days of what I classify as internet funny money, or the ICO bubble, right? Blockchain innovators, promoters, and operators have to look at themselves in the mirror and own the checkered past, in the same way that I think regulators have to own the checkered present of trying to be too paternalistic and too driven by consumer protection standards as a crutch for failing to allow innovation to actually happen. So I think this is where this public-private tension is healthy, and this kind of creative destructive cycle around fintech innovation and blockchain crypto asset innovation is really important and really healthy.
And I just wanted to add one other thing too that we've noticed. I've been heavily engaged with Canadian regulators, and I think we are seeing the world catch up because they're being forced to, like everybody said already. I think what's we've found unique about Bermuda is because of the buy-in across a bunch of different stakeholders across government and the regulator, the pace at which they're able to adapt. This space is growing exponentially. It's hard enough for people that are in the space to keep up, let alone regulators. So I don't envy that position, Moad. But I think what we're seeing in comparison to other regulators is the pace at which they're able to adapt in Bermuda is exceptional. It's beyond what I've seen anywhere else. Like I said, I think Singapore is probably close second, and then I would look at Switzerland and a few other jurisdictions kind of as you go down the list. But because there's one regulatory body, as opposed to in Canada, the United States, like Joseph was mentioning, we have a bunch of different agencies that are we're even trying to figure out where do they fit within each other and what sort of oversight. And so I think it's very hard for all those groups to coordinate and keep up with the pace at which things are moving. Because a lot of this is driven by open source. It's 24/7, and people are contributing and coming up with innovative ideas and building on other existing open source technology 24/7 as well. So it's really I think it's really difficult. But to answer Reese Davies' question, I think Bermuda's still got a significant head start.
It's interesting because this is to some extent on a technical level borderless, but then the ways that different jurisdictions are approaching it certainly doesn't have an impact on what at the consumer level people feel comfortable doing with these various assets. And so we also know that where there's been public-private sector cooperation, whether that's in the form of a sandbox or whether it's maybe even tighter than that, that has been instructive for sure. And so again, from the audience, we have a question. Is there a world where regulators or governments, depending on the critical distinction, I would say there, are creating their own platforms, their own digitally centralized platforms for better global standards and governance for these industries? And does anyone know of examples where you're seeing that kind of investigation or experimentation happening? We could talk about CBDCs, I suppose. That'd be an interesting seg. Anyone want to take that question?
Yeah, I'm happy to start. A very hot topic, of course, at the moment. The sentiment towards central bank digital currencies, of course, has improved all of a sudden. I don't know exactly what particularly spurred it, but nonetheless, the sentiment towards central bank innovation around payments, financial innovations, the movement of money, and all the rest has become an important public policy priority and discussion. My caution, however, is keeping up with the central bank digital currency Joneses and or trying to create guardrails around how money moves in a system because of fear of oversized technology competition is not particularly great for how free market innovation works. And it poses a whole host of non-technological questions about privacy, consumer protection, censorship resistance. Broadly speaking, the use of money to the right of lawful should be as free and universally acceptable as possible, irrespective of the form factor. And so blockchain alone and the advent of digital currencies and digital assets alone are not a panacea for a whole host of global social problems, but they're an incredibly powerful way of allowing people to have digital scarcity, digital asset, and digital representation on an internet native form. And I think that's powerful. And it's really, really important that then is also anchored inside high standard regulatory jurisdictions, as opposed to shadowy internet funny money. So I think this whole thing has come of age. And I'm not convinced that central banks picking technological winners and losers is great for free market innovation.
Interesting. Okay. Oh, Eric, go ahead.
Yeah, I was going to say, I think that's something unique to Bermuda as well, is that they don't have a central bank in the traditional sense. And so as a result, the government is looking at how to embrace and enable the private sector to help innovate and to help improve, financial services in Bermuda and beyond, I think. And so I think that's, to Dante's point, really, really important that, especially with this early stage in the technology cycle, nobody really knows where things are going. Even, down, if we're to get into the nitty gritty around, is everything going to be transacted on Ethereum? Is it going to be on other ledgers? I mean, the reality is right now, Ethereum stablecoin transactions cost too much for regular retail transactions, and they don't scale today. We're now seeing enough liquidity as of the last 3 to 6 months. We're seeing rapid liquidity increases on Solana, where now we've got USDC trusted stablecoins on fast, low-cost rails, and on Stellar as well as of December last year. So all this stuff is brand new, and we're one of the few companies that around the world that have actually made it possible for people to transact on these fast, low-cost rails with a trusted stablecoin. We're talking probably 5 companies that I'm aware of in the world that do this. So this is still so new in the cycle that I think it would be a huge mistake to be prescriptive about the technology. And I think we've even seen that where early adopters like the Riksbank in Sweden that have been implementing their prototype on R3 are now coming to that realization that, and this isn't to knock the Quarter group, but that maybe we want to look at other technologies as well, because the pace of innovation on the open source protocol side and how quickly people are coming up with very groundbreaking consensus mechanisms and throughput improvements to distributed systems, it's been incredible the last 3 years. I mean, we've had breakthrough computer science and cryptography that is just now starting to get tested. And I think it would be a huge mistake to be prescriptive of the technology and even the implementation at this stage.
You know, the Fed chairman made an announcement a couple weeks ago about, should the U.S. have a digital dollar? So, it's on the minds, but I don't think it's a reality yet. And they're so focused, I think, on this DM project with Facebook behind it, nixing the Libra initiative, which is essentially the same. I don't think that, the U.S. is really poised and ready for that. And I think that they're focused and worried on something like the DM project because they may want to issue their own, right? But if you look at all governments, look at the adoption of some of the third world countries of Bitcoin as their primary currency. It's not something you can ignore from a perspective of regulation or adoption, but you can ignore it from, will it be the currency of use? Will it become a real digital currency for the Fed? Will it take off from there? And I think that's a really interesting question, probably for another day, but it's definitely on the minds of a lot of the banks here in the U.S.
I think. Go ahead.
Go ahead.
Go ahead, Moad.
Okay, cool. So I think the question of will governments move with decentralized platforms and the discussion around payment rails, I think there's kind of two different questions, like innovation with money itself and innovation with the rails. And definitely the innovation with the rails is not a monolith. It's not like from government to the end user. There are multiple layers to those rails. And I definitely see a role for governments to improve on those rails with the private sector. So we're seeing some tests being done on wholesale CBDC, on retail CBDC. So I don't think it's a monolith. And I believe that government and the private sector will be able to work together and find where the real customer benefit is. But I see a future where there is room for both.
Okay, so let's say that there's. Oh, go ahead, Eric.
I wanted to add something that's maybe slightly controversial, maybe to this, spice it up, I guess.
Let's do it.
I think my opinion is that open networks win. I mean, we've seen this through history over and over again, through everything from the telephone to cell phone networks to the internet to email. We end up having private information that is required, and then that ends up being interoperable with a public backbone. And typically the way these networks end up scaling is by either having industry specific or regional. But the core, I think cell phones are actually, the cellular networks are probably the perfect example, where we have a bunch of regional operators, but they're all speaking the same protocol. And that's what we're seeing happen with these open source protocols. We're seeing rapidly bridges being built between these different interoperability and payment rails, as Moad was saying. I think the other thing that I've said internally to everyone at Bidali is that money wants to be free. So it's going to try and take the path to least resistance. And we've seen this with capital controls in China. People are incredibly innovative trying to circumvent that, because not because they're doing something criminal, but because they are trying to they're trying to better their financial position and they're trying to improve their life. And I think what's important is striking that balance between consumer protection, AML, CTF, but also enabling this open connectivity. And I think my personal opinion is that this is already happening on the open source side, and Bermuda's approach of having this gated sandbox where you can test these things is important to seeing that actually come to fruition.
So I don't know that money wants to be free is the official tagline of that show, Money Heist, but that's a miss. They should give you credit for that. Let me ask a question a little bit of a different way. So we know we already have a landscape in which there are CBDCs, stablecoin, and crypto. These things all exist. And one interesting question is how they interact with each other. And so where should the push, should there be a push for interoperability? I think we've kind of heard we're dividing up like what you're doing with the money and then the payment rails and all of that, which is interesting. But to the extent that we think that there should be interoperability or there is interoperability that's necessary among these things, should that be driven by the industry, like the private sector side? Should it be driven by regulators? Where should we kind of assign the locus of that responsibility in terms of determining how these things might interoperate? And I think specifically, of course, about on and off ramps into fiat specifically. So how should we make sense of that?
I just wanted to have a quick comment to say that I think it's already happening by private industry, but the responsibility, I think you already know my position. I'm advocating for maybe more open market, open market. But I would be curious to hear from Joseph, Moad, and Dante, having interfaced with a lot of the regulatory side.
Let me throw in a corollary question though, really quickly too, before Dante, you jump in, which is to the extent that things remain in the virtual environment, should a regulator care? If there is no exit into fiat, what is the role of a regulator in regulating something that is, maybe it's in its own way, it's closed loop from the standpoint of it never actually exits a virtual environment? Dante, go for it.
Yeah, so let me give you two analogies, and Eric, I'm going to borrow money wants to be free and pay you a USDC royalty every time I use it, because it's a powerful statement. Many payment systems innovations look like monetary airline miles. They're usable, but only to the users inside the walled gardens. And part of the point that Eric raised, I think, is really, really, really powerful about leveraging public blockchains and open source technology, is that not only does this tear down the walls inside those walled gardens, and it removes financial access, financial inclusion, and financial innovation from being the domain of those companies with the largest spend on proprietary technology stacks, right? So I think that whole problem set of open financial infrastructure that supports public-private innovation, open innovation, is incredibly powerful. It's as powerful an idea as money wants to be free. People want financial empowerment. Is it really your money if you have to ask someone to spend it and pay someone to hold it for you? So I think those concepts are not going away. The broad adoption of the share of a global population that now have these tools in their hands is at a tipping point, right? So not too big to fail, but too big to ignore. That's why everybody's paying attention to us right now. So I think that's powerful. The other piece of the puzzle is, it's really good to have the FAA overseeing aviation safety, but I don't want the FAA building jet engines or flying planes. That's the ultimate threshold matter of public-private balance and how the public interest is represented. We're going to get there. I'm really confident we're going to get there, including in the United States and around the world. I think we're going to figure out how to harness fintech innovation and blockchain-based financial services innovation.
I mean, look, I agree with everyone, but let's have a reality check. The regulators are worried about money laundering, terrorist financing, human trafficking. All of us that want to do good is great. There is an ugly side of the fence on this. There's darknet market activity. These are things we cannot avoid. And that's what they're truly afraid of. They're not trying to police us and say money can't be free. They're saying sometimes money's too free when it's in the wrong hands. And that's where regulation has to adopt the right controls. And that's why closed loop systems are in place right now. Banks are scared. Banks do not want to be tagged with laundering millions and millions of dollars for whatever jurisdiction is up to this type of activity. I mean, you're talking about drugs, guns, Again, human trafficking, these are all scary topics that everyone likes to avoid when we talk about open source and open loops. Closed loops help you avoid that. And that's the struggle. And
Well,
that's not going to go away.
If I could, and Joseph, obviously you and I are friends, and so I know you're not speaking on behalf of banking or closed loop payment systems, but I do think here too, it is too easy to blame cryptocurrencies. And I'm not suggesting that you're doing this, but you've opened up a really important point. By today's financial crime compliance standards, the prospect of somebody who looks like me or Sheila or anybody on this call making one errant payment effectively cuts off entire continents from financial access. The Caribbean basin where I'm from is functionally cut off from financial access because of the cost of de-risking. And so when the post 9/11 financial crime compliance frameworks were designed, we did not have the types of tools that we have at our disposal today. Public blockchain networks can track and trace micropayments in near real time, and you have the whole eyes of the planet trained on these illicit money flows. This is not only stopping events like the Colonial ransomware pipeline and retrieving the funds in real time, it's building an entire cottage industry of unicorns like Chainalysis and other companies that are the veritable fire brigade, the digital fire brigade and the digital forensics brigade, that the opaque, backward-looking, siloed banking system does not enjoy. So I think even on this score, we have a chance to do exponential improvements of financial crime compliance and financial integrity, so that you're right, no payment should contribute to child trafficking, illicit finance, and money laundering. But the scorecard of the existing system is so checkered that if you want to launder hundreds of millions of dollars or billions of dollars, you would pick up a phone and call a traditional financial services firm, more so than you would use any of these public networks.
Yeah, I agree, because cash is still to this day the #1 instrument used, by far more than cryptocurrencies. And that's, nobody understands that. And you're right, everyone wants to blame Bitcoin and blame crypto, and it's a shame, because every time I bring up this argument, the topic gets changed. Cash is the #1 instrument used to launder money in the world.
Yeah, a former federal prosecutor friend of mine always says, any criminal who uses Bitcoin over cash is my favorite criminal because
Right.
I can find them, right, much more easily. So let's go into that a little bit. What do we see playing out in terms of a transition from physical cash to digital cash? Let's say over the next 5 years, 10 years, which is a different time frame, obviously. So feel free to respond to either or both. Do we think that physical cash is going to evaporate and just not be a thing anymore? Or do we think there's always going to be use cases, criminal or otherwise, that maybe small payments that necessitate this? What are we seeing as trends? What do we think? And also, what kind of regulation do we think would affect that transition, maybe accelerate it or decelerate it?
I think you'll see a cashless society. I don't know how long. And our chairman did a interview on CNBC in 2013 about a cashless society. But I think you started to see that over the last 10 years with even debit cards. Not a lot of people carry cash on them. It's hard to convert when you go overseas and vice versa. And I think that eventually you'll see a cashless society. I really do. It's a lot easier if your daughter or your son in Australia needs to have Bitcoin sent to them to use, instead of trying to wire them money, go to Western Union, use the cash apps that are restricted with the dollar amounts. You can only send so much. That's the other piece of this. When do we lift those restrictions? I get it. There's a lot more laundering that occurs with higher dollar amounts, but you still have people that need to send higher dollar amounts quicker than waiting for banks.
I wanted to pick up on kind of both points that Joseph and Dante were making. I think part of the reason we don't see as much criminal activity, like I think Chainalysis and Elliptic have both published independently that it's less than 0.1% of all transactions on crypto networks that they're seeing is involved with illicit activity. Largely it's being used for speculation, and then now people are starting to move into this utility phase with lower cost payments. But I think it's not just dissimilar from a typical technology adoption curves, right? Early adoption from any technology, whether it's the internet and cell phones and email and all these even encrypted chat apps that a lot of people use today, were adopted by people that were using it for criminal activity or gray area, and then early technology adopters, and then you go through a typical bell curve where you have, mainstream and then long tail adoption. And we're going through that with crypto, and I don't think it's any different. Now, will we probably see more criminal activity with cryptocurrency? Yeah, probably. But to Dante's point, I think, I've been on calls with RCMP in Canada, and they have more success tracing digital currency than they would through traditional wire fraud, because even the time frame of coordinating between a bunch of different banks versus going to a company like Elliptic or Chainalysis and saying, hey, we know on an off ramp, we can go talk to these two people, we know it went this way. So we can find out how it was used very quickly. And now some of the tooling is being built such that you can do much better risk scoring because of this programmable money. In the traditional financial infrastructure, we can't even do that sort of risk scoring. Case in point here in Canada, in absence of a real-time payment rail, a lot of people are using a centralized company for less than $10,000 transactions called Interac. A lot of the AML practices for monitoring that is manual, and or banks calling each other on the phone to say, hey, has this person been KYC'd properly? Or are you noticing any other risks? And that's just not scalable. It's just not. And that's what this technology can enable if done right. And that's why I'm advocating for, I think we are going to see, regardless of what legislation is put in place, we're going to see open markets and open networks proliferate. We're already seeing that happen, especially when you can publish code and anonymously or pseudo-anonymously today. But finding that balance of being able to give people better financial access while preventing illicit activity is not an easy one, but I do think it's doable. I think it's doable by making sure that you're gating and utilizing the technology. So gating transactions for risk, verifying people at on and off ramps, and utilizing this technology to flag and follow up with activity that may be outside the norm, without necessarily needing to know who that person is and do any sort of profiling on that individual in order to flag an anomalous activity. And that's something that's just not possible. I think the exciting thing that crypto brings to me is we have the opportunity to separate personal information from transaction history and provide a better global economic environment for everybody, both for the banks and for regulators and for consumers and businesses.
I was just going to say briefly, Sheila, because I think this question of the cashless society is maybe a little too utopic for my likes. And as a risk and national security person, cash is great when the lights are off. And we should never forget that the premise of economic competitiveness in a world that is rife with both technological opportunity and technological risk is to have the broadest possible optionality for how value moves, including in physical form. I remember being in San Francisco at a meeting, walking in, didn't have my phone with me, no contactless, near field computing powered payments, and the coffee shop wouldn't accept cash. Mm-hmm. So that coffee shop lost my business. I took it elsewhere. And I do think we have to be very, very thoughtful and very careful about not exacerbating technological divides, financial literacy divides, financial access divides on a planet with so many internet deserts. The presumption of digital financial inclusion means you have access to reliable internet, low-cost reliable internet at that, and hardware and software that isn't necessarily cheap. So I'm in the camp of broad payment systems optionality, and I'm also in the camp that stable coins like USDC should be treated like digital legal tender or as close to a cash-like instrument, such that they can circulate in digital form and power all the types of services that we've been discussing.
Well, I'm right there with you in terms of spectrum of options being of critical importance. And we've got 6 minutes remaining, and I do want to dive into this topic of financial inclusion. It's a big talking point in the industry, but I would note that the degree of sincerity and approach does vary. And there are certainly protocols and projects, I think, that are quite focused on this topic, and others that maybe are not quite as much. But I think it's important to note, and Dante, you allude to this, that technology alone is never going to solve these problems that are extraordinarily complicated. There are other issues around internet deserts, digital divide issues, infrastructure, access. And so when we think about moving towards a cashless society, which I, for the reasons Dante cited, I'm not necessarily in favor of, I think that financial inclusion involves consideration of empowerment, and empowerment often, it usually leads to choice. It's like, how do people feel empowered to make a choice that's going to work for their situation, their context, which is going to be somewhat bespoke, although you can certainly look at a community level to see what a particular community might benefit from in terms of an option set. But are we just risking enhancing some of these issues? Are we going to just wind up expanding wealth inequality because so much value winds up being created in a virtual environment that not everyone can access because of reasons that are not about the systems that we're building, but about infrastructure and other issues that sit outside of those ecosystems? Who wants to jump into that? Moad, please.
I want to. Yeah, I fully agree that this is a risk, and I think the unanswered question from the previous question, what's the role of the regulator? I think is to think about those things that private actors may not entirely focus on, and try to bring that transformation to something that will make society better as a whole. So when we consider the aspects of that transformation, and even when we use the word disruption, some people will get disrupted. So the role of the regulator is really to try to minimize the externalities while allowing the benefits to emerge. But I definitely see that, in this kind of FinTech environment, there's a lot of focus on and existing programs around the fin part, but on the tech part, people are, developing skills for the younger generation, but there's a very significant risk that, the older generation, or even, segment of demographic might not necessarily have the right tools from a tech side, and understanding who should be a credible actor in the physical world is very different than understanding who's a credible actor in the virtual world. And we've developed, as consumers, reflexes to understand, is this institution, brick and mortar, credible? Should I, give that institution my business? But in the virtual space, it's too recent to really have, these reflexes fully developed. So I think regulators and, the industry has got a role to play in kind of bridging that gap in terms of financial education, but also technology education.
Joe.
Yeah, just to add, from a personal standpoint, I don't want to see cash go away. I think there's still something to having a physical instrument in your hand. And just watching some of the comments go on, no, we shouldn't feel bad giving our kids cash. And, I certainly hope we don't go to an all, cashless society. I think that would be bad in the long run. But, we do have a lot to learn from the nefarious actors, and I think it's an ongoing effort. But tools like Chainalysis and CipherTrace and Elliptic, they've really revamped the way we look at things with their products, and it's helping our law enforcement, the FBI, understand how to trace this better. And that's really important. You're never going to eliminate it. You're never going to stop it. There's always going to be someone out there trying to do something to harm and put a bad name on all this. But, let's face it, I think digital currencies, USDC, they're here to stay in a big way. And it's exciting to see the growth. And and Dante, I can't wait to see what 2022 holds. But we would be a better society to adopt it sooner. And that message really goes to the regulators.
And Sheila, if I could, just on the financial inclusion point, because as you know, it is not only something I personally am trying to bend the arc of Moore's law in favor of humanity, I'm also very quick to say, how can industries and sectors that have had a monopoly on addressing how money moves on the planet since the beginning of time and have failed so woefully by billions of people and millions of people in many countries around the world, including so-called fortress nations, how can you put a purity test on an industry that is now only a handful of years old for having failed a score that you've had a monopoly on? So I would say watch this space. And I think the notion of financial inclusion, living in mobile native and internet native forms of money and value transfer, is only in its beginning act. There are a lot of companies, Circle especially, that are really, really deeply focused on making this a reality for millions of people around the world.
Eric, any final thoughts before we move to close?
I think Dante summed it up pretty well. I mean, I think we are inevitably moving towards digital cash. I mean, I may be on the opposite end of the spectrum where I barely touch cash, and I'm pretty happy with that. But I think, these things don't happen overnight. They take time. In a lot of cases, sometimes they take generational shifts because there's behavioral, beyond just the technology and regulation, there's behaviors that need to change. And this is something that, even as myself building things for digital payments, I still have the habit of taking out my credit card to tap it on the terminal, because that's what I've done hundreds, if not thousands of times. And that's a hard habit to break because of the convenience. We think there's other markets where they're largely cash driven and not credit driven, and largely using mobile devices and used to texting and sending money through mobile airtime. And those are the areas where more likely to have adoption, less friction, and less people that are disenfranchised as a result. But I think one of the comments, that is really important in the chat was, in Bermuda in particular, bringing it back there, what happens after a hurricane or if you have power that goes out. And this is why I think cash doesn't go away, definitely not overnight. And I also think it would be a mistake to try and force it out. And really what things like USDC enable is optionality and the promise of being able to make things better and more efficient while still giving you some of the fallback options, if you need them, to maybe less efficient or maybe slightly more costly, but still fallback options. So I'm excited to see where the future of money goes, and really excited about what they're doing in Bermuda, because I think for us, we spend a lot of time looking at other jurisdictions, and it's kind of the Goldilocks zone right now to be able to test out these ideas, and with the idea of having more private industry help innovate.
Well, I'll just say, as a closing point, I am the mother of 3 young kids, and I often say I'm raising crypto natives. And what does that mean? It has Web3 implications. They're not going to have the tap of the card as their default mode of payment. I fully expect that they will operate in a very different environment. And so I think we have to respect and the demographic shifts that are going to happen, the cultural shifts that are going to happen, as some of the things that are quite new to the points that the panel has raised here become more commonplace. And I think that the role of the cooperation I think we're seeing between industry and regulators is in some cases to be creative in our imaginations about what that world might look like, how we might be creating a more inclusive world that addresses the problems of those who lack access to financial services, that addresses the coming demographic shifts, but also very much respects the need for those who are not necessarily at the cutting edge of that change to retain systems that are familiar and to benefit from the ways those systems have actually provided security and safety to many, many people all over the world. So I want to thank our panelists so much today for sharing your insights. This was a fascinating discussion. I know that I learned a lot. I know our listeners learned a lot, and we really appreciate it. And to all those listening, thanks so much for your lively comments, for providing questions that helped us spur this conversation. And we wish you all a very lovely end of your day and week. Thank you so much.
Thank you, Sheila.
Thank you, Sheila.
Thank you, Sheila. Good time.